Unveiling the nexus. The impact of interest rate expectations on bond prices and yields. In the intricate web of financial markets, the relationship between interest rate expectations and bond prices yields a tapestry of complexity that both astounds and challenges investors. The delicate dance between these two elements plays a pivotal role in shaping the fixed income landscape, influencing investment decisions and market dynamics. To unravel the enigma, one must delve into the nuanced mechanisms that govern how interest rate expectations reverberate through bond markets, ultimately impacting prices and yields. The interest rate bond price conundrum. At the heart of the matter lies the inverse relationship between interest rates and bond prices. As interest rates rise, the value of existing bonds tends to fall, presenting investors with a conundrum. This phenomenon, known as interest rate risk, underscores the critical importance of understanding how interest rate expectations can shape the trajectory of bond prices. Consider a scenario where an investor holds a bond with a fixed interest rate of 3%. If prevailing interest rates in the market climb to 4%, newly issued bonds begin to offer higher yields, making existing bonds less attractive. In this environment, the market value of the 3% bond is likely to decline, aligning with the higher yields available in the market. Investors holding bonds with lower interest rates face the prospect of capital losses if they decide to sell their bonds before maturity. Conversely, when interest rates decline, the value of existing bonds tends to rise. Investors holding bonds with higher interest rates than prevailing market rates benefit from the increased demand for their bonds, as they offer more attractive yields. This inverse relationship between interest rates and bond prices underscores the impact of interest rate expectations on the market valuation of fixed income securities. Yield dynamics in a shifting landscape. Understanding the impact of interest rate expectations on bond yields requires a closer examination of the yield to maturity (YTM) concept. YTM represents the total return anticipated on a bond if held until it matures. As interest rates fluctuate, the YTM of existing bonds adjusts to reflect the prevailing market conditions. Consider a bond with a fixed coupon rate of 4% when issued. If interest rates rise to 5%, the YTM of the bond must increase to align with the higher prevailing rates. Investors seeking to purchase the bond in the secondary market will demand a discount on its face value, pushing the bond's yield higher to match the current market rate. Conversely, in a falling interest rate environment, the bond's YTM decreases, leading to a premium on its market price as investors are willing to pay more for higher fixed coupon payments. Duration as a shield against interest rate volatility. Investors navigating the bond market must also grapple with the concept of duration, a measure of a bond's sensitivity to interest rate changes. Duration provides a tool for estimating the potential impact of interest rate movements on a bond's price. Longer duration bonds exhibit greater price volatility in response to changes in interest rates, making them more susceptible to interest rate risk. For instance, if an investor holds a bond with a duration of 10 years and interest rates rise by 1%, the bond's price is likely to decline by approximately 10%. Conversely, a bond with a shorter duration of, say, 3 years, would experience a smaller price decline of around 3% in response to the same interest rate increase. Investors can strategically use duration as a shield against interest rate volatility, aligning their bond portfolios with their risk tolerance and market expectations. Market sentiment and forward guidance. Interest rate expectations are not solely shaped by economic indicators, they are also influenced by market sentiment and central bank policies. Central banks, as custodians of monetary policy, play a pivotal role in communicating their outlook on interest rates to the market. Through tools like forward guidance, central banks signal their intentions regarding future interest rate movements, providing investors with insights that shape their expectations. Consider a central bank that communicates a commitment to maintaining low interest rates for an extended period to stimulate economic growth. This forward guidance sets the stage for a market environment where investors anticipate a prolonged period of low rates. Consequently, bond prices may rise as investors seek fixed income securities with higher yields than those expected in the future. The interplay between market sentiment, central bank communication, and interest rate expectations forms a complex tapestry that influences bond prices and yields. Global dynamics and interest rate differentials. Interest rate expectations extend beyond national borders, creating a global interconnectedness that ripples through the bond market. Disparities in interest rates between countries can drive capital flows, influencing currency exchange rates and impacting the attractiveness of bonds denominated in different currencies. For instance, if the interest rates in country A are higher than those in country B, investors may be drawn to bonds in country A to capitalize on the higher yields. This increased demand for bonds in country A can drive up their prices and lower their yields. Conversely, bonds in country B may experience lower demand, resulting in lower prices and higher yields. The global dynamics of interest rate differentials introduce an additional layer of complexity for investors navigating the bond market. Conclusion. In the intricate symphony of financial markets, the interplay between interest rate expectations and bond prices yields a melodic narrative that captivates investors and shapes the trajectory of fixed income investments. As interest rates ebb and flow in response to economic indicators, market sentiment, and central bank policies, investors must navigate the complexities of interest rate risk, duration dynamics, and global interconnectedness. Understanding the impact of interest rate expectations on bond prices and yields empowers investors to make informed decisions, strategically positioning their portfolios in anticipation of market shifts. As interest rates continue to dance to the rhythm of economic forces, investors armed with a nuanced understanding of these dynamics can navigate the bond market with confidence, embracing the challenges and opportunities presented by the ever-evolving landscape of fixed income securities.